Hey guys, welcome back to the Success Seekers. Today's video is going to be a little different format. We're not going to be showing my portfolios or anything like that. We're going to be talking about a huge issue that stock market YouTubers and content creators and just investment gurus do not talk about enough. The dark side of the stock market. You hear a lot about there's an 8%, 8 to 10% return in the S&P 500 average per year. You throw your money in, you're getting 8 to 10% a year. It's going to go up. It's going to go up. The market's only gone up. Everything's going up. Like, you hear all these bullish remarks. It seems like everything's going to be great. Toss all your money in the S&P 500. Throw it into stocks. Wait a little while. Cha-ching. Well, I'm here to tell you that it is not that simple. And it also does not always work that way. Yes, there may be an 8 to 10% average return for the stock market if you throw your money in the S&P 500, but that's an average. It doesn't just smoothly go 8 to 10% up a year. There are years when it'll go up 30%. There are years where it will do nothing, and you will get the same amount of money out as you put in at the start of the year. There are years where it goes down, and we're going to be talking about those periods of darkness in the market where your money will go down, where you will lose money if you are not patient and waiting and doing it right. So a couple of things that I have been doing some research on. The first specific instance of this is in 1987. Back in 1987, there was what is infamously called Black Monday. The Dow Jones fell down 22% in one day. Imagine that today. You put your money in the stock market, you wake up the next morning, and your money is down 22%. What are 99.99% of people going to do? They're going to pull their money out. That's terrifying. 22% in a single day. And now it did recover that Black Monday in 1987. But if you put your money in the peak right before that dark day occurred, it would take you all the way till 1989, 2 years later, to break even if you invested at that peak. So there are some people that invested at that time where it took 2 years to recover from that single day drop of 22%. 2 years not of making money in that time, 2 years just for them to wait to get their money back that they put in. Another instance, January 2000 to January 2013, 13 years. If you put your money in January in the market in January of 2000 and you pulled it out in January 2013, you'd have a 2% return. You were in the negatives all the way until then. It took 13 years to break even on your money. This is also what's known as the lost decade. Just 13 years of no returns from the market. Imagine if that happened today. Imagine if 2024 to 2034, no money was coming back from the market. You put your 10 grand in the market today, and it took you until 2034, 10 years of your life later, just to get your money to break even. That's a possibility. It's happened before, multiple occurrences, which I'm going to keep talking about, and it could happen today. 1998 to 2003, it took 5 years to break even if you invested in that time. If you invested in 1998, it took 5 years, all the way till 2003, to get your money to break even again. Not make a profit, not go up, break even. 2007 to 2013, it took 6 years to break even. 6 years. You put your money in 2007, you had to wait till 2008, 2009, 2010, 2011. You get the point. 6 years to get your money to break even. That is a long period of time. And most people during that time frame are probably counting their losses, taking their money out of the market. If you are going to invest in the market, in the S&P 500, you have to have a long-term mindset. I suggest people that put their money in the market that you don't want for at least 5 years, but now I'm thinking maybe longer, because 2 years to break even from 87 to 89 took 5 years to break even from 98 to 03, 6 years, 2007 to 2013, and then 13 years from 2000 to 2013. 13 years or no return on your money in the market. It is not a short-term get rich quick scheme, guys. Now, imagine if you were retiring in that time frame. Imagine if You are building up your retirement savings. It's finally that time to call it quits. Turn in that last paycheck, and you find out the day after you leave your job, the market has fallen 22%. Your 1 million that you had stashed away, it's now 750,000 overnight. You lost $250,000 overnight. A similar thing happened to the COVID crash. I personally know someone who was supposed to retire right around when COVID happened to happen. Her investments, her funds plummeted. She had way less money than she thought because it just happened to be that the market tanked in her retirement years. It's also for another video, but that's why it's important to move your money out of the volatile stock market, S&P 500, and more into bonds and high yield accounts, CDs, things like that as you get close to retirement. Anyways, I don't mean to fearmonger. Let me re-encourage my position as a bull. I am a market bull. I believe very strongly in the S&P 500. I put all my money into stocks. No, not all. Diversification is important. I put a majority into stocks. About 70% of my investments are in stocks. I'm very bullish, but there's a reason for that. It's because I know I have time on my side. Personally, I am in my early 20s. I have 40 years until I plan to retire. I mean, hopefully I retire earlier, but 40 years scheduled for retirement. I have time to withstand even a 13-year period in the market. I am not a fearmonger. I'm not a bear. I love the market, but I just want to insist the importance of understanding the way the market works. Two important things. Number one, do not try to time the market. Buy on a recurring schedule. If you are investing every single week, no matter if the market is down 22% or up 22%, you're going to have a good average cost building, and you will steadily be following the market upwards. If you try to time the market, it went down 10%. Man, this is the bottom. I'm going to I'll buy now. Well, what happens if it drops 10% more? Well, now it looks like you bought your stocks at an expensive price, and you have no money left to buy at that lower price. I'm not saying hold money for each time it drops. I'm saying spend all your money by dollar cost averaging. Use your money up to dollar cost average. Reoccurring schedule. Do not keep your emotions out of it. Keep your timing out of it. Number two, that's really important, is to diversify. Do not invest in stocks alone. Do not invest in stocks alone. Have some money in a high yield savings. Build up your emergency fund. If you're going to have money in stocks, make sure you have a 401k going with your work, something that is retirement, so you have all those years to withstand these drops. Have a Roth IRA. A brokerage account is fine, but you should make sure you have your emergency savings, you have some sort of retirement account going, and you understand the way that the market works. These long periods of up and these long periods of down, that can happen. Plan for long term. Next point I'm going to make is plan for long term. Once you have, those comfy emergency savings, a 401k with your work going, or a Roth IRA if you don't have a 401k access, the extra money that you wish to invest with needs to be at least money you don't want for 5 years, ideally 10 or 20 years or longer. That's why I like retirement accounts like a 401k, for example, because you can set it, forget it, and pull it out at age 55 or older. For the majority of you guys that watch my videos in your 20s and 30s, that means you have 20, 30, sometimes even close to 40 years before you decide to pull that money out of your stocks. So a retirement account is probably a good, smart option for you. It also helps because when the market is plummeting and you want to pull your money out, you remember that you can't without a penalty because you're locked in a retirement account. That sounds like a bad thing, but it's actually a good thing. It helps me have discipline, and if you're like me, when you might get a little worried, you might want to sell out in positions, you realize, well, why would I sell out? Because I'll have to just put it into other positions. If I sell out, I can't put it in my bank account. It's a retirement account. So that's a good thing to think about. The longer your money is in the market, the more power it has to grow with compounding. and the longer you have to recover from the downturns. So that is the advantage of keeping it in for so long. And if you're around my age, you're in your 20s, you're in your 30s, maybe even 40s, if you have multiple decades left until you plan to pull your money out of the market, why not put it in a retirement account? At first I was like, well, a brokerage account is great because I can pull it out whenever, no withdrawal, but there are great tax advantages to a retirement account. And it got me thinking, like, I'm planning to keep it in as long as possible, so might as well put it in a retirement account because it feels like a long time. It feels like I'll want it earlier, but I don't think I'll want that earlier because I'm not putting every dollar in the market. I'm putting only my excess money after emergency savings, after, I have a high yield savings account going, I have money in my 401k, I have all my bills covered, I have rainy day funds. Stocks are the last thing you should put your money in because of the volatility and time it takes in the market to get those great coveted returns. So yeah, guys, that's what today's video is about. It was a short one, but it is a serious thing to consider before you invest. I know you guys hear me giddy on all my videos like, oh, buy, and I am. I love the market. Buy stocks, absolutely. But it would be unfair, and I would not be doing my due diligence to continue to post my content without making this bit of a disclaimer, this reality check, that there can be up to 13 years of the market doing nothing but slightly going down. There can be up to 13 years of your money going down. So that's I know it's not typical. You can look at the S&P 500 over a total time. It is like that. It is an upward slope. If you have time on your side, your money will grow. That's why I'm bullish about it. But if you don't think you can withstand 13 years of your money sitting before it makes money, the stock market probably isn't right for you. And that's okay. That is okay. I'm coming to terms with the stock market might not be right for everybody. High yield savings, CDs, those are good ways to grow your money. I think that everybody could benefit from having some of their money in the market, but monitor your risk tolerance and how comfortable you feel. If you don't think you can withstand 13 years, maybe have only 5% of your savings in the market versus, me 70% of my savings in the market. Just something to consider, guys. Till next time, thanks for tuning in, and I'll see you guys in the next video.